Today on Evaluated Pricing. Capital markets firms face huge amounts of challenges, and COVID-19 has brought along even more market volatility and valuation difficulty. Some market analysts have predicted that even more market stability in the near term will happen and will occur. How will future market volatility impact the methods and assumptions used to value the fixed income and over-the-counter securities markets? Joining us today to share greater insight on this topic is Joseph Hayek, Head of Compliance and Controls, Refinitiv Evaluated Pricing Service. Joseph, thank you for joining us.
Thanks, Keesa. Thanks for having me.
Great. So let's jump into, first of all, what we're seeing today, Joseph, off the back of that horrible video that we saw in Minneapolis last week and numerous others, and the ongoing calls for justice. We're hearing that this is impacting the financial markets by further reducing investor confidence, which quite frankly has already been scarce. How is this impacting the fixed income and over-the-counter markets specifically?
Yeah, so the events that are unfolding are quite sad, Keesa, but they haven't had an effect on the bond market yet. I mean, we haven't seen it. The last couple of days have been relatively stable in the bond market. I think the reason for that is that risks are already baked in given COVID-19. So obviously there's a high unemployment, and the sectors that are suffering are still in the same predicament.
Great. I see. So let's turn and look at evaluated pricing itself. Less liquid assets like fixed income, like over-the-counter instruments, are more challenging to value than equities. And we're more dependent on underlying assumptions and inputs from capital markets pricing and valuation services. So, Joseph, we've seen some pretty drastic swings in the market, and some analysts are warning that the recovery will not be a V-shape. The recovery will not be a W-shape, that in fact, it's going to be even more dire than that. So what impact will these market conditions that could go beyond V's and W's, what impact will that have on fixed income and over-the-counter securities pricing?
It's been a wild ride the last 3 months, and though volatility has tapered off, I don't believe we're out of the woods yet. I can provide some insight into what we've observed, and we're hoping we don't observe that in the near term. So the first few weeks of the crisis, volatility in liquid assets was quite high as asset managers sold their most liquid bonds, mainly in the short-term area. Flight to quality caused a substantial drop in U.S. Treasury yields. The 10-year Treasury note dropped below 1%, which has never been seen, ever. Widening of the bid-offer spreads across all asset classes. Fire sales of trades as certain institutions, mainly levered hedge funds, began unwinding. And from a pricing service perspective, we saw a lower quantity of observable quotes, basically 50% less than normal. And this is the type of data we use in order to value our securities. Now, market conditions have become somewhat stable. We've started seeing much better quotes in the market. The AAA benchmarks have reverted back to pre-crisis level. Certain sectors continue to underperform, while other sectors are overperforming or outperforming. So the underperforming sectors typically are like airports, senior living facilities, convention centers, hospitality, retail, gaming, oil and gas. Those continue to underperform, while the outperforming sectors are in the technology space, in the telecom, certain financial services. And usually from our perspective as a pricing service, the sectors that continue to underperform, determining fair value becomes challenging.
Okay. And I'll just stop to let you know, I seem to have a flying co-anchor here. So if you see me swatting, it's because I have a co-anchor with wings. So please pardon me for that. And I just want to take a step back. I know most of the folks who are on the live stream probably have a keen understanding of what evaluated pricing means and how it connects with the fixed income market, how it connects with the OTC market. But could you give a basic understanding of what is evaluated pricing and what is over-the-counter securities? What does that mean? And how that impacts what's going on in the market now? So just a basic definition of that.
Right. So over-the-counter securities are usually securities that are not traded on an exchange. exchange. And for the most part, the bond markets are non-exchange traded. And with these securities, typically price discovery is not as simple as an exchange trade where you see a lot of transactions. So the bond market itself typically trades approximately on a given day, 3% of the bond market may trade on a particular day. And so from our perspective, in order to price securities, we aggregate this information. We also aggregate bids and offers that we see in the market from market participants, from data aggregators. We take all that information, we take the analytics, and we're able to price and extract pricing and extract certain data that we use to price hundreds of thousands of securities across the board.
Okay,
and
great.
so evaluated pricing currently publishes prices approximately 2.6 million securities globally. So not only US, Europe, Asia, across the world.
So, and that really summarizes why this is such a huge area, because of the market size of the pricing. So appreciate that. With that being said, understanding the size of the market and just the overall universe of the market, what have been some of the main points that you're hearing from these market participants? So whether they be clients, whether they be others who are in the market, what's going on from their perspective, and what common themes are you hearing from each of the clients and each of the participants that you're talking with now, Joseph?
Right. So the main pain points that we've observed with our clients is that given the fact that you have a series of data points and disparate data, particularly in times of volatility, it becomes very difficult to identify where fair value actually is. I'll give you an example. So imagine you're an investment firm that holds fixed income securities and usually uses two pricing services, a primary and a secondary, to price their fixed income holdings and to strike their NAV. Now, during a volatile day, they trade certain bonds, so they have certain data points that they've traded. They've also observed bids and offers throughout the day. The market is very volatile, the market shifts. At the end of the day, they come to price their portfolio and strike a NAV. And obviously, the two pricing services have as well two different prices. And all the prices that they've observed were 1, 2, 3 points apart for something that is relatively liquid, that is relatively investment grade. And so with that, then it becomes a difficult problem and an exercise that they have to go through to identify which price determines fair value. Is it pricing service A or is it pricing service B? Should they override the pricing service? Because again, they've observed better information in the market or they've done trades. Now, imagine this is happening across thousands of securities that they hold in their portfolios during a 2-month volatile period. So you can imagine the daunting exercise that they actually have to go through. Now, this leads as well investment firms to challenge the pricing services, which obviously they're seeing information, our pricing, we're seeing a different side of the market and additional information. And therefore, they will challenge the pricing service, challenge the price to make sure that the price is what we're publishing is correct. And what we've observed during that period is 4 to 5 times more than the normal price challenge volumes on a typical month. And the quality control process on our end became quite intense because obviously all these challenges have to be reviewed, have to be signed off and responded to the client.
So let's talk about those underlying assumptions and methodologies that you're mentioning that is baked into this process. Do you expect some of those underlying assumptions to be changed, or is there even a need for them at this point to be changed? What are your thoughts about how we will see the market assumptions for pricing moving forward?
So typically methodologies for pricing securities don't change that often. However, assumptions and inputs that go into deriving a price do, particularly with volatility. So with the volatility, the assumptions and inputs are updated more frequently to ensure that prices reflect fair value. And the difficulty primarily comes with securities that we call fallen angels. And usually when a company's debt is rated as investment grade, then within a short period of time, the debt becomes distressed. And with its debt becoming distressed, then the price where it's trading as investment grade all of a sudden falls because it's relatively a distressed security. Now, with liquidity and price discovery drying up, the security becomes much harder to value. And we've observed many such companies, particularly in certain sectors, where the debt was investment grade, being traded quite often, then all of a sudden security dries up because obviously it's become a fallen angel and it's become a distressed security. And this is where it becomes much harder to value as a security.
Great insight. And to let the live stream know, we will be opening up to questions momentarily. So please go ahead and send in your questions so we can get started on those. But meantime, from a regulatory perspective, Joseph, what can you tell us about the new SEC rule that's now coming into play that's expected to impact this space? What are the timetables and how can capital markets firms, first of all, how are they impacted? And then how can they comply?
So the last time the SEC issued a comprehensive guidance on valuations, believe it or not, it was in 1970. Wow. So it's definitely been due for a revamp. Now, although the US and European accounting bodies have published fair value standards, ASC 820, IFRS 13, most recently in 2006 and 2011, the newly proposed SEC rule adds more detail around compliance program that must adhere to fair value and how within a compliance framework it addresses fair valuations. Now, without getting into too much detail, the rule establishes a principle-based framework to determine value in good faith. It also expands valuation obligations to fund boards and not only to the investment advisor. So technically now the fund board has to be involved in a more active fashion in fair valuation of an investment advisor or the fair valuation process. And being more active, meaning they will be obligated to receive a certain amount of information on a monthly basis, on a quarterly basis, ask for detailed reporting about the valuation process within the investment advisor. And so they become a more active player in the valuations rather than a passive activity for them. Now, that also brings up much more scrutiny on pricing services. And within the SEC proposed rule, there is a particular section that addresses pricing services. And given the role that pricing services play in the valuation world with pricing millions of securities, and we become a highly dependent source for investment firms to price their portfolios, obviously we're going to be in some form or fashion scrutinized in terms of the information we provide, in terms of how we value securities, the information, the underlying assumptions, the inputs, and so forth. Now, sorry,
just going to interject. So you mentioned a bit there about the activity, the fund board's activity has to increase, et cetera. I'm wondering if we could talk about what resources that these folks will now need to make sure that they can keep up with this new ruling. And also the side that we don't want to talk about, but it does exist. What are the consequences if they do not meet those goals that are now laid out in the SEC ruling? So what resources will they need to help them get to where they need to get to? And what does it look like if they fail to get to where they need to get to?
Yes, that's a good question. Thanks, Keesa. So larger institutions most likely already have a certain framework in place and a certain program in place. So it's a matter of adding some additional requirements. So I think it's just probably adding additional requirements, and probably with the use of automation, they can actually achieve that. More likely, the medium to smaller size firms will most likely have to consider what additional resources they will need, because this is definitely a game changer in terms of the information that's going to be required at the board level. And at the same time, from our side as well, we'll have to consider, given our clients, we have to consider what we need on our end and what we need to publish and what we need to provide our clients, so that way our clients can provide the required or have the necessary information to present to their boards.
We have a question from the audience here, and the question is, do you think a rotation into EM equities makes sense at this time in this risk-return scenario?
I have to say, Keesa, whether I know the answer or not, unfortunately, in my current role as compliance and within Refinitiv, we typically don't provide advice. So it becomes very difficult for us to provide advice in terms of what clients should be doing, whether we should be getting into emerging markets equities or debt or whatsoever.
Okay, all right. Well, we'll just move to the next one. So no advice giving on that question, but do you see your clients discussing that? Can you at least let us know what the discussions are that you're hearing about emerging markets? Do you hear a lot more conversation now than you did a few years ago, or is it about the same?
I personally have not. I'm not so sure whether our desks have. I mean, typically, our evaluators are close in contact with the markets and market players and market participants, and obviously they're much more in tune with that level of detail. Now, from my perspective, I'm more of a higher level oversight across evaluated pricing, and in terms of focusing on the compliance controls methodologies, but not necessarily from a specific detailed desk perspective.
Okay. How is technology impacting the regulation of price valuations?
Technology is a godsend. I mean, without having the right technology, I think it becomes very difficult and very challenging from both an investment firm to come up with, the right appropriate and to ensure the right checks are in place to ensure fair value. I recall in 2008 when I was implementing ASC 820 at a large investment firm, technology had really helped us put the right infrastructure in place and put the right indicators in place to allow us to determine which securities we were uncomfortable with and we needed additional data in order to determine fair value. And at the same time, it's also exceptionally helpful from a pricing service. When you're a global pricing service and you're pricing millions of securities, you have to ensure you capture the right information, and you take that information, you ensure that it's assigned to certain buckets and assigned to certain comparables, and you price securities based on all this data that you've captured. Now, in the event you don't have the optimal technology in place, it becomes very challenging, becomes very difficult to price so many securities.
Okay. So I'm hearing a lot about technology and a lot about onboarding vendors to really help with this pricing. I can't help but to think there is going to be a substantial cost involved. And with the new SEC ruling, it sounds like that cost might increase. What can the capital markets firms expect to see in terms of the cost to them to keep up with these rulings?
Yes, I expect as well that a certain amount of cost will need to be dedicated. Budgets need to be dedicated to technology. Where given the demand, given the scrutiny, and unfortunately, it doesn't stop here. This is just an ongoing process. Perhaps the SEC last time it updated its rules were in 1970, and now we have a new modern valuation framework. But all of that, given our advancement in terms of financial markets, you need technology to keep up. And it's going to require a certain budget to ensure you have the right quality controls in place, to ensure you have the right infrastructure, the correct pricing. And all of this is definitely costly.
And so when you say a certain budget, could we even look at percentages? Do you think that, generally speaking, 10% more than folks are currently spending, that would be more accurate? Or could you give us a sense of what a certain budget would look like for those who are really contemplating how to bake this into their costs for this year or even for 2021?
Right. I can't really opine on the budget and percentages, because obviously this rule is now just basically came out. It came out in April. There is a comment period that goes back to the SEC where firms, and including us as a pricing service, will be involved in the comment period as well. And we're going to be working with the SEC on this, or working with our compliance and legal folks. And we expect that the rule will be published towards the end of next year. So it gives us some time. It gives us a year and a half to begin planning and begin basically defining exactly what needs to be done. Now, once you go through that definition phase, then you involve technology and you say, well, how can I do this? What is it going to be? What is the budget going to be? And obviously, whether business, the business management makes that decision to continue with that development in order to meet these regulations.
Great. So I'm going to switch gears a bit and go to the audience questions about LIBOR. So in terms of 2021, what should clients do to ensure a smooth transition? And what are you doing, your team? What do you hear that's being done in the marketplace in terms of LIBOR in 2021 and really ensuring that smooth transition?
Yeah, so we have a team internally that focuses on LIBOR. So LIBOR and SOFR and some of the other rates that are going to be switching. So we have a team that is dedicated to focus on this across Refinitiv. An evaluated pricing service is currently part of that team. And the team focuses on, what is the upcoming events that may arise. At the same time, we're coordinating closely with some of our clients to see what they're seeing as well and how we can manage this transition. But it is something that, in addition to the SEC rule, it is something that is very keen on the market where the, certain loan securities that currently use LIBOR will be transitioning to SOFR, and that's what we're currently assessing.
Okay, great. Next question. Since fair value is largely based on judgment, it generally leads to a potentially biased view of value. How can data help inform this judgment? And what are you all using now to value?
Right. So, it is based on judgment, but then, here's what I have to say. It is based on a judgment call in certain aspects, but it's a boxed judgment call. And if you have the right processes in place, and if you have the consistency in place, so technically the certain sources of data that you're taking in, you have consistency in terms of methodology, in terms of how you apply your assumptions, your inputs. And at the same time, you have quality controls in place that look at this data and ensure that there's no deviations in the way we approach pricing. Then you can ensure that you have a good judgment in place that is relatively consistent. Now, obviously, particularly with hard to value securities, you can get the three top minds in valuations, put them in the room, and each will come up with a slightly different value. They're not going to have valuations on top of each other because there are certain assumptions that are factored. There's cash flow assumptions, there's risk assumptions that are baked into a discount rate, and you also have to consider your quality control. Is it a one-off or is it a consistent pricing with the appropriate quality control in place and appropriate risk mitigation to ensure that you have the right price?
So in terms of the new environment, especially with the expectation of the future market fluctuations that we talked about a bit earlier, what should capital markets firms be looking for in pricing providers? What are the top 3 items, would you say, are the most important?
That's a very good question. I can come up with 10 top items, but then I'll limit it to the top 3. I would say definitely access to market data and network as well. So terms and conditions, aggregating quotes, aggregating market color, having transaction information, having curve information, and news, up-to-date news, because obviously, as I mentioned, companies like Fallen Angels, they, at one point they're trading as investment grade, then they become immediately distressed given the market environment. So this, I would say, is a key point. The second, I would say, is a network, because in order for you to aggregate data, you need to be in touch with the market. You need to have market participants where you're definitely in touch with market participants that can assist in times of information. And at the same time, you need subject matter expertise. So experts within your organization. I mean, this is a complex, securities in general are quite complex. You can easily value a plain vanilla bond, but bonds are not plain vanilla for the most part. And you experience hard to value securities where you need that expertise. You need quant expertise, and not only fixed income, although I've focused on fixed income, but we also do derivatives as well, which are even much more complex. So we have a derivatives team that does bespoke derivatives and does OTC derivatives as well. And so you need that subject matter expertise in place. So, and sorry, I'm going to go two more. I'm going to go two more because I think it's very difficult to limit it to three. Technology and automation. Technology and automation in order, again, to apply this market data across thousands of securities in a single second. And you need to constantly update your technology because things change within the technology world. And finally, I'd like to say and maybe I have a biased view because I am responsible for compliance and controls, is that a good operational risk program, because the amount of data that you're publishing out there and the fact that our clients are the most highly regulated in the industry, typically they expect a good operational risk program to ensure that there's compliance, controls, audits that occur, and those controls are managed on a daily basis. So I would say just as a just to recap, access to market data, subject matter expertise, technology, the network, and I would definitely the operational risk program.
So those top 5 items that capital markets firms should be looking for. Joseph, thank you so much for joining us. Joseph Hayek, Head of Compliance and Controls, Evaluated Pricing Services. Thank you, Joseph. We'd like to thank everyone for participating today. And if you have enjoyed today's live stream, you can also download our latest report, which explores the differences in respect to the challenges facing capital markets firms and their valuation challenges by typing in the address on the screen or scanning the QR code seen on your screen now. Thank you so much, everyone, for joining, and be well.